Hi everybody, Hadar here from webuyproperty.co.nz. The Reserve Bank of New Zealand have announced a game-changer strategy to try and cool the Auckland housing market. From the 1st of October 2015, any property investors who seek to buy a property in the Auckland Regional Council, meaning the wide super city of Auckland, New Zealand, will require a 30% deposit, 30% down payment if you're looking to buy a property, an investment property, which you're not going to use as your own home in the Auckland Regional Council. Every new mortgage will require a 30% down if it's an investment property. So this could be very challenging for many investors in the Auckland marketplace. I will also share with you a few strategies which you can use to tackle the challenge. To name a few is joint ventures, vendor finance known as seller's finance, equity release strategy, and few more. I will also share with you which property you can buy in Auckland which are not required 30% down payment. So a little bit about myself. My name is Hadar Orkibi. I'm a property investor and trader. I'm a member of the Auckland Property Investors Association and the Otago Property Investors Association. I have a buy and hold portfolio in Auckland, Christchurch and Central Otago. I trade properties regularly, mainly in Auckland, and I use the proceeds for reducing debt and cash flow. I do joint ventures mainly on trades and development, short-term transactions, and today I will cover the 30% challenge. So let's jump straight into it. As mentioned, from the 1st of October 2015, any investor in the Auckland Regional Council will require a 30% deposit if they're purchasing a house which is an investment property. At this stage, it's only for the Auckland Regional Council. Let's see what happens in the future. New retail mortgages secure on residential property that is not owner-occupied. These are the loans which will be required to have the 30% deposit. And there is one exception, which is the LVR restrictions will not apply to loans to construct new houses or apartments. So if you're buying a property off the plan or a property from a developer, which is a house and land package, there is a possibility there to borrow up to 90%. Overcoming the 30% challenge in about 30 minutes. The strategies which we can apply are joint ventures, vendor finance, also known as seller finance, and equity release strategies. Joint ventures. What is joint ventures? Joint ventures, it's property investors who team up to put themselves in a stronger position, to use one person's strength to offset the other's weaknesses. This enables both parties to pursue their real estate goals. The key for investors who are interested in doing JVs is to find partners who has what they lack of. So if you are interested to know more about joint ventures, you can refer to my joint venture presentation on the Appia TV, on the Appia website. This is free for members, but a paid subscription to non-members. Highly recommended to become a member and also to pay for the subscription and watch those videos if you are a member. There's some great videos over there from various professionals in the industries and some very good movies as well. So before you start joint venture, you require to decide if it is a long-term buy and hold or is it a short-term trade transaction. Team up with a fellow investors or family member to raise the 30% deposit. For example, if you again have only 10% deposit or 15% or even the required 20%, Maybe a family member or a friend, another fellow investor would like to do a joint venture and put in another 10% to qualify for the 30% deposit. Decide on the joint venture's terms. Would you pay interest for the fellow investor or family member who gave the extra deposit that you didn't have? If it's a trade, would you share the profit with them? Or if it's a long-term investment, would you share the cash flow or just give them part of the cash flow for a set period of time? There's few requirements there how to make a win-win situation for both parties in the joint venture. So again, deciding on the terms is very important. So again, would it be an interest payment on their part of the deposit that they contribute to the deal? Would they share the profit if it's a trade, or whether it's a long-term hold that you're planning to sell after 10 years? Would you share the profit as well as paying interest on the deposit? Or maybe you can share the cash flow. Those three keys, something that we should take in account before you go into a transaction as well. The key factor for all the strategies which we're going to cover in this presentation is to purchase properties which you can add value to. Add value to the property and recycle the deposit. No matter what you do, it's always an advantage and a good exit strategy to have an opportunity to add value to the property and recycle the deposit. So if the partnership needs to be resolved, or if it's time to resolve the partnership, there is an opportunity there to recycle the money out and give it back to the joint venture partner. And this is exactly the same, could be applied also with the vendor finance. After you added value, you can release them from what they left in the deal. Also with the equity release, which we will cover later on in this presentation. So again, buying a property which you can add value to, regardless of those three strategies, this is a key factor and a key strategies which I apply to any property I buy, whether it's a buy and hold or whether it's a property which I buy to trade. But it's very, very important, especially now, to be able to recycle the deposit. Because if you have a team member, or if you have a fellow investor, or even a family member who contributed some cash into the deal, you want to be able to release them from the deal if required. Therefore, to be able to recycle the deposit, it's a key factor moving forward. So buying properties you can add value to, remember that. Pay the deposit off from cash flow. If a joint venture partner, whether a family member or a friend, contributed some percentage of the deposit into the deal, whether with interest or without interest, whether it's a family member who just helped you out for the next year or two, you can pay off the deposit from the cash flow over a period of time. This is a very good strategy as well. Vendor finance. Vendor finance or seller finance. Currently, the main banks in New Zealand don't like vendor finance. I've spoken to my ANZ commercial banking manager, who I deal with regularly, and they inquired that a bit further up the chain. They came back advising the bank will not entertain a vendor finance transaction. They are not looking at it favorably, and I think personally that the only way to find out would be to challenge it with the sell and purchase agreement, which has the appropriate clauses inside, suggesting a vendor finance as a second mortgage. Until there is more clarity about the new changes and regulations with the 30% deposit, their opinion is unfavorable of vendor finance. That leaves us with vendor finance as a difficult option to most investors, but there are a few ways that we can still use vendor finance. One of them would be for investors who can actually withdraw, let's say, 50 or 60% of the equity from another property without borrowing it, or whether they have cash and ask the vendor to leave the rest of the money in for a period of time. And there's a few other options which we will cover now. So the first option I mentioned is if you have equity in another property, this is probably for more of stabilized investors with a lot of equity. If you can withdraw a lot of equity out and have a bit of cash which you can throw into the deal as your part of the deposit, then perhaps you can convince the vendor to leave the rest of the money in with interest payment. And let's cover the rest of the options. Agree on the time frame, the interest rate, more than the bank and in advance will be very attractive. Well, if they are getting 4 to 5% maximum at the bank at the moment, if you offer them to pay 6 or 7% or anything around 8% will be very attractive. Or perhaps you are able to pay the interest in advance if they want to go on holiday. If one of the reasons of selling is going on holiday, maybe some of the interest payment you can pay, or all of it will go towards that. So that's basically answer one of their needs. That's very attractive to the vendor. Principal reduction payment. This is again a strategy which will work, paying off the money or the equity that the vendor left in the deal over a period of time, whether it's 1 or 2 or 3 or 4 years, with interest or without interest. If you buy from a family member or a friend, there could be some more flexibility there. If they are not in a hurry to release all the funds, maybe they will be willing to leave equity in the deal and receive interest payment on the equity, because they're going to put the money in the bank anyway as a term deposit. It is very important to talk to a good mortgage brokers. Mortgage brokers have a lot of clients and a lot of experience also with banks and non-banks lenders, private lenders, asset lenders, and I have a lot of clients who maybe have some money which and properties. Have some clients with properties with equity, and they might not mind to leave the money in the deal and receive reasonable return on their equity which they leave in the deal. A third and last strategies for this evening is equity release. Again, with equity release, it's very important to add value to existing properties. And remember the golden rules which we mentioned earlier is buying properties you can add value to. So also with your existing properties, you can add value to your existing properties and release some more equity and use that cash as a deposit for your new purchase. You can do that by adding value, whether it's physical work or whether it's do a new registered valuation to top up the loan or extend your flexi facility if you require that, which is the line of credit. Equity in another property as a security. Perhaps you have portfolio with some equity in it. So again, you can give that equity as a security and use that to release some more cash, to use the cash as a deposit to purchase more properties. Equity in parents or relatives' home, whether the parents or relatives have equity in their own home, this could be used as an assistant if they are willing to lend you some of the money. Again, going back to maybe the joint venture strategy, to release some of the equity as cash, and you can use that into your new purchase. Passive investors. There is many passive investors in this world, people who have term deposits or even some money in shares that giving them not such great returns at the moment. Those people you could possibly borrow some cash from and use that as a deposit for your next purchase as well. Sell underperforming properties for cash. We're not going to get into the debate of paying tax on your profits or not. It depends on the time frame you own the properties and various other circumstances. But sometimes if there is an underperforming properties, it could be a good idea to sell them and go and buy elsewhere properties which are performing much better, and buy a property maybe with more growth prospect or with less maintenance and something which is more good long-term investment. Few alternatives to keep in mind. I've been consulting my mortgage broker John Bolton from Squirrel Mortgages here in Auckland, and those 3 points which JB have pointed out to me. Fund through non-bank lenders like Resamic. That could be a way to pass through the 30% challenge. Split your properties between banks to preserve equity when selling. Split your properties between banks to preserve equity when selling. And the reason is that most people don't realize the rules also apply when you sell. Banks may require you to pay back more of the proceeds of sale than you were expecting. Talk to a good mortgage broker. This is a key factor. I highly recommend that for you to talk to a good mortgage broker who can guide you through and look on your overall situation to see what are your options there and how you can tackle this 30% challenge. Thank you, Apia, and I apologize for not making it in person to present this presentation. If you have any questions, please feel free to contact me through my website. You can visit me on webuyproperty.co.nz, and I wish you all have a good evening and successful investing.